Richard, we've had some horrific movements of share prices in the mining sector of late. Well, we've had some horrific share price movements anyway, but the miners have had a bad time. And just thinking overnight in Australia, Fortescue's numbers were out. Not particularly special, but the shares were down 14%, 15%. Tell us a little bit about that.
Absolutely. I mean, the two share price movements are not completely unrelated because Fortescue ships iron ore to China, and China's slowdown is worrying anyone with mining shares at the moment. But its profit fell 90%. Now, that was bad, but it was even worse than expected, despite shipping a third more ore to China and selling it. So, big shock there.
Right, and so, but the Australian dollar, it's weakening versus the US dollar. Is that not helping some of their local costs?
Definitely. This is the good thing about Fortescue's results is that they have shown tremendous cost discipline. They brought their costs down by about a fifth, more than a fifth, in fact, from a year ago. So that is one thing that's helping. The thing is they keep banging on at Rio and BHP for overproducing and failing to scale back production. They don't have that amazing financial wiggle room that the BHPs and Rios of this world have. And in fact, we're still looking at Fortescue, a company which has just had to renegotiate, refinance part of its $7.2 billion net debt pile. So this is a company that, although it's doing some of the right 101 how to get through a crisis if you're a miner type things, it's still got a bit of a
so there's a lot of risk
constraint.
Here, right? Yeah, there's a bit of balance sheet risk. And now another thing to think about now is we should probably be focusing, if the market already is, on which balance sheets are the worst in the mining sector. Now the spin out from BHP, South 32, where they put some of the businesses that they didn't want so much in a separately listed vehicle. How did that do? That doesn't have much debt, does it?
It doesn't have much debt. Its profits fell, and that was expected, but these were its maiden full year results. What its debt figure does is position it in a completely different place from much of the mining sector. Its net debt of $402 million is not even a quarter of its earnings before interest, tax, depreciation, and amortization. So I call that real wiggle room, and it's also less exposed to China. Only about 11% of its sales go to China. So this is a company that is not having to renegotiate debt like Lonmin. It's not having to sell stuff like Anglo-American to fix its balance sheet. It's got real scope for M&A, dare I say, or to be the target of M&A if Mick Davis, for example, comes in and has a tilt at it.
Okay, so if investors are looking at the mining place, they probably want to look for slightly safer things. South 32 might be the sort of thing, but do watch that balance sheet position, right? Okay, Richard, that's very interesting. Thank you.